Hello and welcome everyone. Our next presentation will be getting started in just a few minutes with Tom Hutchinson. Thank you for joining us. Our next presentation will be getting started in just a few minutes. Once again, I just want to welcome everyone into the room. Our next session will begin in just a few minutes. Thank you for joining us. Alrighty, Tom, can you hear us okay?
I can.
Excellent. I'm going to offer you a brief introduction and you'll be ready to take the stage.
Will do.
Excellent. Well, I'm delighted to welcome everyone to our next session. Tom Hutchinson is a Wall Street veteran with experience in stock trading, mortgage banking, and commodity trading. Specializing in income investing, he has served in a financial advisory capacity for several of the nation's largest investment banks. Tom, it's a pleasure to welcome you. The stage is yours.
Thank you very much, Jordan. And good afternoon, everyone, and happy St. Patrick's Day. I'm thrilled that you're joining me today. The topic is the Dividend Solution, how dividend stocks have replaced the bond market. My name is Tom Hutchinson. I write newsletters for Newsmax Media, including the High Income Factor and Breakaway Income. And I'm going to talk to you today about some sort of basic tenets of investing. I'm not going to go into whether technology stocks are bouncing back permanently from the recent correction, or how long will the cyclical stock dominance last, or cryptocurrencies, or any of those near-term things in the market. I want to talk about something incredibly basic that affects how people invest. Now, you may have or have had a 401k or other sort of managed accounts. And depending on your age, you put a certain amount in equities or stocks and a certain amount in fixed income or bonds. And as you get older, your allocation changes to the more conservative fixed income bonds, less equities. And that's how it goes. And that formula has worked very well for a long time. But things are changing. And that formula is unlikely to work well going forward. And I'll explain why that is. But there is something you can do about it. And I'll explain what that is. But first, let me identify the gist of the problem. Now, very basically, as interest rates rise, bond prices decline. As interest rates fall, bond prices rise. And there's a reason why that is. Let's say you get a bond that pays 5% and interest rates rise to 7%. Well, your interest rate is steady, so the market will price in the coupon your bond pays at the new higher rate, so it will discount the bond, so it pays that rate, and vice versa. Now, ideally, you want to invest in bonds at a time when interest rates fall for two reasons. One, that you lock in the higher rate before it goes down, and two, that the value of your underlying bonds increase. That's the situation. You don't want to be invested at a time of rising interest rates. Now, let's take an aerial view of where we are, sort of the long-term picture, and let's look at bond rates. This is the 10-year Treasury bond yield. And this is the long-term picture from 1960 to 2020. And if you look at those rates, you see something interesting. They peaked, as you see, in around 1981, about 16%, and have been steadily declining ever since. It's basically been a 40-year bull market in bonds, with interest rates trending lower and bond prices rising. But as you can see, how much is left in the tank of that bull market? How much further can interest rates fall? They're almost at zero, as you can see from the chart. Now, it seems like they have no place else to go but higher, which would be bad for bond investors. It could be that perhaps they stay around this level for a while. But even if it does, what are you really getting? And when you focus on this complete picture and time frame, it shows that bonds are currently low paying and treacherous. But that's not the way it's been through most of your investing careers. Here is the return of these are average annual total returns by decade of the Barclays Aggregate US Bond Index. And that's sort of a broad-based benchmark of US investment grade bonds. It includes treasuries, agencies, corporate bonds, mortgage-backed securities as sort of a basket. Now, there's other bond index measurements. You can measure it to government bonds or municipal bonds, but they're all going to be slightly different, but the gist is going to be the same. The higher returns before. If you look at the 80s, owning the Barclays Aggregate US Bond Index, you would have averaged a return of 12.75% per year. Just in the bonds. In the 90s, it got a little more realistic. You would have averaged 7.88%. In the 2000s, 7.54%. All pretty good returns. In the 2010s, last decade, however, that return was cut in half to 3.75%. And year to date, the return is negative. The total return on bonds is falling and unlikely to improve. Now, let's take the longer view. Let's forget since rates peaked in 1981. Let's just go for the long, long haul, the past 90 years. What have we been looking at? Well, the stocks, as measured by the S&P 500, has averaged 10.29% a year, while bonds have averaged 5.33% a year. So you have gotten a decent return from bonds for a long, long time. And this reflects what I talked about earlier, the investment designation between stocks and bonds and the mix. So you can see from 1928 through 2019 what your total returns have been. With a 30% stocks, 70% bond split, you got 7.21%. With a 40-60 split, 7.77, 50-50, 8.29, and 60-40, more equities, 8.77. So you can see the more equities you have, the higher the return has averaged. But still, with a good percentage of your investments in bonds, while you haven't gotten the 10% plus from the stock market, you did pretty good. And those returns are with far less volatility, far less agita when the market goes down. And you've also gotten an income, which is very key. It's not only the total return, a lot of people need income from bonds. Here are the current rates as of, I think, the day before yesterday anyway. 10-year Treasury bond, 1.63%. The iShares iBoxx investment grade corporate bond ETF, which is a representation of investment grade corporate bonds, 2.72%. A AAA rated 20-year municipal bond, 1.6%. And the Barclays Aggregate Bond Index ETF, 2.15%. These rates are not going to facilitate the returns that you saw above. Because of where rates are and its inability to go much lower, your total return is hampered, but also your income is far less than it was. And that's a problem. It's a problem in the aggregate because overall, there has never been a greater need for an income. There are much fewer pensions than there have been in the past, and many people will be retired for 20 or 30 years. And in retirement, you can't take a lot of risk. You don't want a lot of volatility, but you need a decent return. And many people need an income from their investments because you don't want to spend your principal and exhaust your nest egg. I mean, you can't live for 20 or 30 years in retirement necessarily spending all your money, because if you run out, then what? So you need an income, and that's hard to get. But the scope of the problem is massive because the demographics of society are changing in a big way. Population's getting old. It's gotten old, and it's getting older still at warp speed. About a third of the American population is now over 50 years old. Fastest growing segment of the population, 65 and older. On average, 10,000 baby boomers are turning 65 every single day and will continue to do so for another 8 years or so. See, what happened 65 years ago, we were in a baby boom. and society was cranking out babies like crazy, massive population bubble. Well, 65 years later, they're all getting old and retiring. And that has a big effect on things because all those people, a lot of them are going to retire, and many will have to figure out how, with savings and investments and income, to sustain themselves through retirement. And they haven't laid the groundwork. The average length of retirement, 18 years. Now, that's average. Some people be retired 30 years. Percentage of workers covered by pensions shrinking. And the average annual Social Security benefit is $17,536. How's it going? Well, the median retirement account is about $58,000. You translate 5% of that as an income of $3,000 a year. So if we take the median private pension, assuming you get one, add that in, and the average Social Security benefit, and you get somewhere a little over $29,000 a year. Tough to sustain yourself on that. That's a problem. It's a problem on two sides. One, people are not saving enough. So you need to save enough with a level of risk you can tolerate and stay invested and grow your wealth. And two, you need a higher income. The solution, the answer, is dividends. Dividends are stocks that pay out at regular income, sometimes quarterly, sometimes monthly. But the total return, historic total return on dividend stocks in general, has been excellent. And they've provided much less volatility than the overall market. As well, unlike bond interest, dividends grow over time. They increase as companies grow the dividend, so they're not stagnant and keep pace with rising rates or inflation or what have you. And there's also the availability of some pretty high yields. Now, here's a historic rundown of the S&P 500 and a look at the average annual returns by dividend policy. And this covers the periods 1972 through 2018. Now, dividend payers on the S&P 500, companies that pay dividends, have provided over that period an average annual return of 8.78%. Companies that do not pay dividends have provided far less of a return of only 2.4% average annual. But here's the kicker. The dividends have outperformed with far less volatility than the non-dividend payers. So not only have they given you more, they've given you more with much less pain and agita along the way. Now, why have dividend stocks been more successful? Well, there's two reasons: the money and the company. The money, dividends have actually been a fair percentage of market returns. Going back to 1928, dividends have accounted for roughly 41% of the total market return, just in the money. You don't realize it in a go-go market like we're in now, but during other markets and flat markets and down markets, dividends are a big part of return. Then there's the company. Companies that have a proven ability to pay dividends and raise the dividends year after year and continue to earn the cash flow typically have an excellent investment niche and can make the money. They have a reliable business with reliable cash flows. And history shows companies that are able to pay regular dividends tend to be far more profitable overall than non-dividend payers or the market index as a whole. Now, if you look at the long term, what happens with the growth of $100 over the long term? In this case, 1973 to 2020. And you can see that dividend growers and initiators are the biggest performers. That $100 added up to over 11,000. Dividend payers, not necessarily growers, about 7,000, compared to the overall S&P 500 return of a little over 3,100, 3,700, and non-dividend payers return of just $844. So you can see, and this is with dividends reinvested, over time, it makes an enormous difference in the return. But I want to get a little bit off the theoretical. $100 back to 1973, that looks great. Let's look at some real life examples of returns in the past 10 years, something relatable, something manageable, of household names, dividend stocks, and household names. Now, over the past 10 years, let's say you invested $10,000 in the S&P 500 or these 5 stocks. A $10,000 investment in the S&P 500 with dividends reinvested would now be worth about $37,000. Now, I took a good sampling of household stocks. Some did better, some did worse. But you can see some of the returns you're looking at and realize that if you want to save for retirement or accumulate wealth, you can do a pretty good job of it without risking losing your shirt. With companies like Home Depot, McDonald's, Pepsi, Visa, Intel. Now, some stocks, again, they beat the return of the market, some didn't. But if you look at the average, it far exceeds the market. And to get high returns with a reasonable level of risk is actually quite reasonable. And if you give it a little bit of time to look at it, you can see how it's effective. Now, in terms of income, well, yeah, the 10-year Treasury is paying 1.6%. 2-year CD is paying what? I don't know, 1%. So it's hard to believe that you can get any kind of return for your money. And this is one of the reasons that the stock market has been so resilient, because money really has no place else to go to earn a decent return but stocks. Now, here's some high-yielding stocks that are a reasonable level of risk, that have yields that the bond market has not paid in eons. And they're not really high-risk stocks. One is cigarette company Altria, currently yielding 7.1%. Historically, it's been one of the best performing income stocks on the market. Lately, it hasn't, but it's cheap here, and that's why the yield is so high. Yet they're growing earnings despite the headlines. They have a 50-year track record of increasing the dividend every year, and the company has more than enough free cash flow to cover it. Example number 2, Enterprise Product Partners. And what this is a midstream energy company, meaning they don't pump the oil or sell it to the end user. They transport it through pipelines and store it in their facilities. They're not overly exposed to volatile commodity prices. They just collect a fee for the service and transport of all that oil and gas sloshing around the country. Stock is dirt cheap after the pandemic and the hit the energy market took. Sells at a very cheap valuation. The dividend, the distribution, is rock solid. The company has 1.6 times coverage in distributable cash flow, which is tops in the industry. And it even maintained that through the pandemic. So they're going to pay that dividend. And now the energy sector has momentum. So you can most certainly get high yields and also achieve total returns. And those are the two enormous issues. Total return, so you can grow your wealth and save money with a reasonable level of risk, and current income, which you can no longer get in the bond market, in the investment grade bond market, or through traditional income vehicles and methods. At Newsmax, I run 2 financial newsletters, and they each address a different problem. In the high income factor includes dividend paying stocks, and the emphasis is on wealth building and total return over time with a decent level of income with moderate to low risk. This is a place you go if you're saving for retirement. If you don't need a high income yet, but will, and you want to build your wealth at a reasonable level of risk. My other newsletter, Breakaway Income. The objective of this newsletter is to provide you with a double-digit annual income while preserving and even growing principal. I do this through several methods: buying high-yielding securities and writing covered calls, which is an interesting strategy, which I explain if you do subscribe to the newsletter. So these are the problems that we're facing. I have newsletters to address them. That's the world we live in. That's the current circumstances. But we need to adapt. We need an income. We have to find one. We need to grow and preserve wealth. We have to figure out a way to do it. And with that, that concludes my presentation. And I would like to open it up to the audience for any questions.
Hey, Tom, can you hear me okay?
Yes, I can.
Excellent presentation. So many wonderful comments in the chat. Many people saying this is one of their favorite presentations. They've seen all the events. So I just wanted to say thank you again for joining us today. And let's jump to our first question from one of our viewers. One of our viewers writes in, can pension funds move to bonds when they have expected returns of 6 to 9% on their portfolio, or are they stuck with stocks? I'm not sure why bonds would attract pension annuity capital.
You mean, I guess, how do pension funds invest their money?
Yeah, I guess, yeah, exactly. So exactly.
And that's a very, very good question. They're not doing a lot of bonds if they're getting an average annual return of 9%, like you mentioned. They have to be somewhat in the stock market and dividend stocks, like I said. But there's, for high net worth individuals, and especially pensions and endowments and money with fiduciary responsibility, there's also a big investment these days in alternative investments, which include investments not included in the traditional stock and bond markets, but in private equity and real estate. And there's been a big push in those directions as well, which explains why the returns are still pretty decent, while bonds are so low paying. They can't put all the money in the stocks. They have to diversify risk. And there's a new field in alternative investing that a lot of them are doing.
Excellent. Thank you so much. Our next question is, our viewer writes in, for a young man in his early 60s and retired, what percentage should I keep in a dividend equities?
That's a very tough question to answer because everybody's circumstance is unique. So let me just speak in very general terms. Money that you're going to need to take out and spend in the next 5 years or so, you probably don't want to put in the market because you never know what's going to happen. I think it's appropriate for longer term money, money that you're not going to have to touch, and you can ride out the cycle for a while.
Excellent. Thank you so much. Our next viewer writes in, what dividend ETFs would you advise looking at?
Ooh, that's a pretty good question. Because I don't personally buy a lot of ETFs. I invest in individual stocks in my newsletters and have my own portfolio. So my favorite dividend ETF is really the High Income Factor newsletter. But look, if you have to choose, you can go general with the overall market and get the S&P 500 dividend ETF. You can also, there are ETFs, I think NOBL, that tracks dividend aristocrats. Those are companies that have grown the dividend for 25 years or longer, reliable dividend payers, and it focuses on those stocks. If you want to be a little more aggressive, there are some dividend paying technology funds. That's a way to participate in the tech sector, get a dividend, and not have to choose any one stock. So that's probably where I would head if I did buy ETFs.
Thank you so much. Our next question is, with your covered call writing, are you using the premium to generate income dollars, or are you suggesting that individuals manning their own to write covered calls according to your newsletter?
No, I have a portfolio, and I do trades in the portfolio and display them in my newsletters and weekly updates. But the design is to have the individual investor write those calls for himself. I identify what calls to sell and when to sell them. But the idea is for you to do it and generate an income for yourself.
Okay, thank you. Our next question is, what do you think of preferred stocks as a dividend generator?
I like preferred stocks. I do. I like them for a couple of reasons. They pay a lot more than bonds, which isn't saying much, but they sort of have a performance that's not directly correlated to either the stock market or the bond market. So it's a nice way to get a fixed income without taking some of the risks that the bond market has, and to diversify yourself a little bit out of the stock market. So I like the asset class very much. But again, you have to mind what you're buying. There are some real high risk preferred stocks and some investment grade ones. But in general, I give it a big thumbs up.
Excellent. Thank you. Do you see a time where bonds will be back to previous returns given the current huge stimulus packages of printing money?
That's a good question. Now, let me answer this truthfully. Historically, or by every economic measure we've had, look, if you print money, the economy booms, interest rates are unrealistically low, you're going to get inflation and rising interest rates. But that hasn't been the case. If you look back over the past decade and in the years following the financial crisis, there's plenty of easy money, not to the extent there is now, and low interest rates, and we really didn't see any inflation and rising rates. Eventually, I think we have to at least see some inflation with these trillions of stimulus floating around. I honestly don't know if you're going to get a bump back up maybe beyond the average we saw pre-pandemic, or you're going to get something much more scary, commensurate with higher inflation. I don't know. I'm going to have to wait and see. But I think the overall direction of rates is higher. How much higher? I'm going to have to wait and see on that. Excellent.
All right, our final question. Would you agree that AbbVie is one of the best overall stocks to own since it provides a 4.8% yield and excellent growth opportunities?
I would agree. There's other good ones, but AbbVie is top of the heap. Now, the reason I love it is because these drug companies are all about new drugs and the future and the current revenue. And the best thing you can have is a pipeline of promising drugs and new drugs, newly launched drugs that are doing well. AbbVie is about the best of the business in that. And although they're facing some competition for their blockbuster Humira drug, I think they'll overcome it. I invested in Eli Lilly about 10 years ago. It was in a similar situation. It's done gangbusters. Meanwhile, AbbVie is still cheap. I think it sells at about 8 times or something ridiculous, 8 times forward earnings, and pays a high and safe dividend. So yeah, that's a good one.
Excellent. Well, Tom, unfortunately, we are out of time. I know our audience wishes we could stay around for another 30 minutes and answer questions, but I want to thank you again for joining us today. It's just been an excellent presentation, and we really appreciate you being here.
Well, thank you for having me, Jordan. And if anyone needs to contact me at the email address or the number below.
Excellent. We appreciate it. And Tom, we hope to see you at a Money Show in the very near future.
Thank you. It was my pleasure.
Excellent. And thank you everyone for tuning in today. As a friendly reminder, you can replay this session and every session from the event by visiting virtualpass.moneyshow.com. Have a great day, everyone. Thanks so much for tuning in.